I'm Dawson Schmidt here with the latest stories and developments in this week's Commodity Roundup on Trader PhD. An annual look at farmland values shows prices continue to increase in 2026, but at a lower rate. The USDA's annual land values summary last week showed that U.S. cropland values averaged just over $6,000 per acre in 2026. That is up 3.3% than in 2025. While farmland values clocked a sixth consecutive increase this year, the rate of those gains has been declining over the past few years. In 2022, cropland values saw an increase upwards of 14% year over year. The Corn Belt region saw values increase 3.8% from last year to an average of $9,280. Three Corn Belt states broke above the $10,000 per acre mark, and those include Illinois, Iowa, and Ohio. Iowa does lead that trio at $10,700 with a 3.9% increase from 2025. While growth in land values have been showing signs of slowing, Lance Honig of the National Agricultural Statistics Service says cash rents for agricultural lands are already at a crawl.
And there we saw pretty slow changes happening there. In fact, very similar to what we saw last year. Last year's values were very similar to what we saw the year before. And so this is really 2 consecutive years of pretty steady cash rental rates.
The cash rent value for cropland averaged $160 per acre. That was actually down from last year's previous $161 per acre. Despite cash rent falling as for the national average, regional averages largely increased in 2026. States in the Corn Belt, Northern Plains, and Southern Plains saw mostly modest increases for cash rent prices in year-over-year comparisons. Cattle futures continue to recover this week as the market shakes off selling pressure. The most active October live cattle contract traded about $2 higher on the week by Wednesday, and that followed a $4.75 jump last week. The rebound is firmly backed by tight fundamentals. The USDA's July inventory report confirmed that the U.S. beef cow herd remains down 1%, with the annual cow-calf herd projected to drop another 2%. On top of that, intense summer heat is dragging down pasture quality and reducing carcass weights, while weekly slaughter numbers fell well below last year's levels. Beef packers have likely been able to slow down some processing speeds to manage high cattle prices, but the idea of a slow recovery in the U.S. herd remains a supportive factor. With supply remaining historically tight and consumer demand for beef holding strong, the path of least resistance for cattle prices does remain upward. The University of Purdue's Center for Commercial Management released its July Ag Economy Barometer. The latest survey showed producer sentiment rebounded after 3 consecutive months of declines, but that doesn't tell the whole story. Producers were asked what types of risk management education would help them the most in the upcoming year. 44% of those respondents said that learning more about marketing was at the forefront of their concerns, and that beat out financial management and strategic planning. In the same survey, 30% of producers identified crop and livestock prices as their biggest challenge facing their operation over the next 5 to 10 years. Researchers said that the July survey reflects improving confidence, but not a return to optimism across the farm economy. Despite the improvement to the overall barometer, important concerns do remain. High input costs continue to limit expectations for better farm financial performance, while crop and livestock prices were identified as the leading long-term challenge. Thanks for watching. I'm Dawson Schmidt, and this has been Trader PhD.